There are three ways that I have used technical analysis in my career as a fundamental analyst. First is to predict what quant funds are going to do. As passive funds and quantitative funds have increased their influence on markets, it's important to know where a stock could start to have downward pressure, and then that pressure might increase just because certain technical triggers were set. The second way that I use technical analysis as a fundamental analyst is looking for support levels. In 2006, I joined Oppenheimer Funds. I was responsible as the tech analyst in mid and large cap for $6 billion in assets. One of my portfolio managers shared with me that even if I wasn't a heavy user of technical analysis, if you looked at long-term charts, you could see where the bulk of people had purchased a stock. This is known as a support level. I'll show this to you in a moment. The third way that I've used technical analysis, much more in the second half of my career, is following the 80-20 rule. You can do a tremendous amount of work on fundamental, but if your technicals aren't there, you have a whole host of people that are not going to purchase the stock. And if the technicals are healthy, you have a whole host of people that will purchase and continue to own the stock, saving you a tremendous amount of time in terms of predicting when a stock is going to work. I'm going to talk about three areas of technical analysis that I use most often. And those are looking for support, moving day averages, specifically the 200-day and the 50-day, and Bollinger Bands, which define two standard deviations above and below those moving averages. Here we are on Yahoo Finance. I know it seems like professional investors have all these advantages, but I'll tell you a secret. When I was at Oppenheimer Funds, I had a near unlimited budget. We had subscriptions to every single professional service, and I spent 85% of my time on Yahoo Finance because that's where you get the raw data and you can make up your own opinion. So don't think you're at a big disadvantage. The tools that I'm going to show you today are all free. I went on Yahoo Finance to quote lookup right here, typed in Google, and here we are on Google. It gives you the summary, company outlook, chart, etc. So we're going to jump into chart because this is about technical analysis. There was a chart on that first page, but it doesn't allow you to run any moving averages. Now it's going to load the interactive chart. I'm at a 5-year. Now I could go to a 6-month. It gets a lot more messy. I look at the short-term charts as much more useful for people who really specialize in technical analysis, which I don't. This is about being a fundamental analyst using some technical analysis skills. The first thing I look for in technical analysis is support. Where are buyers going to support the stock? Where are they going to not support the stock and sell? At any given point, when one person is buying a stock, someone else is selling the stock. When one fund is buying a stock, someone else is selling. At any given price, that's the price that the current buyers or current owners have recently purchased the stock at. So you want to look at what's been happening recently and what's been happening over a longer period of time. You can see that September through December, there were some sellers of Google down to this 2,600 level. And then at 2,600, there's people that are saying, no, I really think that I'm going to buy on a dip. I want to own more. And there's still people that will sell at that price, but there's more buyers than sellers at 2,600. So that's driving the stock back up. At the 2,987, there's more sellers than buyers. And so it pressures the stock down. That was the same case here in September at this 2,900 level, where there were more sellers than buyers. So net, the stock was going down. Now, this is somewhat relevant, but it's a very short time period. It doesn't tell you a lot. It tells you that near term, people are thinking it's a buy around this 2,700 and that it's a sell around 2,900. And as more fundamental data comes out, the overall market may decide that at 2,900 it's a buy. That's what was happening here. You could see in the February to April period, there was a pretty consistent buyers and sellers right around that 2075 level. There's an equal number of buyers and sellers, not enough sellers that people were willing to trade it lower, but not a consensus to drive Google up. Here is where fundamental analysis comes in, because earnings gets released and people are more excited about the future prospects of Google, and the stock starts increasing again. That's how I look at it on a shorter term basis, but the real value for looking for support is on a longer term basis. What I want to look for here is if the market breaks down or if something goes really wrong in the stock, what's going to happen? Where's support? This is a tough one, because when you look for support on a long-term basis, you're looking for where's the bulk of people been purchasing the stock. Even if you go back 5 years to 2017, Google traded in this range of 1,000 to 1,200 for a number of years. All of a sudden in 2020, we had the pandemic. Everyone was relying on their computers, working from home, and we all went remote. All of these platform stocks did very well. So you don't really have support of people that are saying, I bought at 1,200, and so if it dips 5%, I'd like to own a little more, because it's more than double that support price. So even though you may think at 28.85, wow, that's impossible, that could never happen, that Google would go all the way back down to 1,200, down more than 60%. These things can happen. One of the stocks that really surprised me was Cisco. And when I was speaking to this portfolio manager that I mentioned at Oppenheimer Funds, he was saying when Cisco was reaching its all-time highs of $80 in 2000, you can see that March 19th of 2000, when Cisco was reaching these all-time highs, he was talking about the support levels for Cisco are $1. This is where a lot of people were buying it. Of course, these are with stock splits. This is one level of support. And then he was talking about this next level of support in here that I'm showing you, which is around the $7 to $10 range. Support is really where you see a lot of churning. There's a lot of new buyers coming in, and buyers and sellers are agreeing on the stock price, not just driving up the stock price higher and higher, but there's some agreement at the stock price. All these S's, by the way, are stock splits. You had some support levels in here, and you had maybe a little bit in here at the 20 and 30 level. But here in March of 2000, you had a very similar chart. This is not a prediction because these charts can go for quite a while. So this is Google, this is Cisco. So it's not a prediction. But when you think about what support means, here are the areas where there were lots of buyers and sellers transacting at similar prices. In 2002, we hit our lows back at this $11 level, back at this support level that we see in here. You would never think that Cisco would go from $79 back to 11, down 80%, because at the time Cisco was the entire infrastructure of the internet. They sold routers and internet traffic was growing. Everybody was going to be using the internet for commerce. All of the things that have actually come true today were what people were predicting. But it's not that people were wrong about how the internet would evolve. It ended up that more competition came in, et cetera, and the whole internet bust happened. The point here is that the support levels are going to tell you when the fundamentals start to go down, where are the buyers and where is the pain point? Let's talk about another one. Here's Facebook. I'm going to hit the quote lookup, and then I'm going to go over to chart. Let's look at that same max chart that we were looking at with Google. Here on Facebook, you can see a nice steady growth. And this area, 2018, this was actually a decline in all tech stocks that Facebook participated in. Some of these pullbacks are pullbacks in tech entirely, and some of them are worries about regulators. No matter what the cause of these pullbacks, they still tell you where people are willing to transact. This is where more sellers than buyers appeared. They were selling, 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 down to here, where then buyers are saying, you know what, even with all those risks, it's worth it. What happened here in December was that the Fed lowered rates when they had been talking about increasing rates, and they changed their mind. They lowered rates and people got excited for technology and growth again. No matter what is happening fundamentally, technically, this is the price at which people are willing to transact Facebook. Even if the same thing were happening in tech, Facebook could have gone down more in that same time period if more sellers wanted to sell and buyers weren't willing to buy at that price. Even if it's trading down with the entire group, this still tells you what people are willing to pay for Facebook given any set of circumstances. I'm looking at this chart in terms of support. I'm looking at 148 to 208, so 150 to 200. That has gone on from June 2017 to May 2020. For 3 years, people were trading Facebook between 150 and 200. Then Facebook starts rallying. Without looking at any moving averages, what this tells me is there's a group of people that bought it between 150 and 200. Now the stock is double to up 75% from where they bought it. So they may say, that's a bit too rich for my blood. If Facebook were to come back down to 175, there's a bunch of people that for them, they bought it at 200, they'd be buying it at the dip. There's all these people that bought it that would be buying it at a significant dip, but they might find that feels too risky. But there's this whole group of people in here that still have a 5% profit or maybe a 5% loss that say things have gotten better with Facebook. A year has passed. I feel like it's an even better value, and they'll come in and buy it again. So that's support. Psychology has shown that people would much rather avoid the pain and shame of a loss than they would to celebrate a gain. The moment that you think maybe I'm going to have a big loss, you'd rather avoid another 5% gain if you think that might cost you even a 5% loss. So what happens here is this support level of 175, halfway between the people that were buying at 150 and people buying at 200. When that support level is broken, that means that the people that bought it at 200 are now looking at a 30% loss, and they're like, forget it. This thing has come down from 300. Now I'm at a loss, even though I used to have a 50% gain. Now I'm looking at a 30% loss. Forget it, I'm selling. Now, if you imagine that the stock goes below this level, the support are just these little sets of people that were buying it at 105, 107. The next level of support is down here where the stock was churning back in 2013. Now, do I think it's going to go all the way back there to 2013? That's going to depend on a lot of other factors. It may not, but you have to go back and look at stocks as strong as Cisco to realize that depending on the environment, it could happen. That's how I look at support levels. The second piece that I look at are moving averages. Here in Yahoo Finance, I just go into indicators. I hit the plus and I'm going to say moving average. And I'm going to pick two moving averages. I'm going to pick the 50-day, which I'm going to make that one red. Then I'm going to put in the 200-day. And I'm going to tell you why I put in both. I'm going to just type in 200. Now we have the 50-day and the 200-day on our chart. There's a lot of things if you get into technical analysis that I frankly don't know and don't use. But they do have some fun names. When the average price over the last 50 days goes below the average price of the last 200 days, that is a quick way to see that you do not have very much support. That is called the death cross. And the opposite, when the 50-day rises above the 200-day, that's telling you that people are very happy, they're making a lot of money, volatility is your friend, and that is called the golden cross. Let's look back at what we're talking about with Facebook. This area here between 200 and 150, the 200-day is right at that 226, bringing in some of the support level here from the 273, including the longer term support level that we're talking about that went from spring of 2017 to spring of 2020. So that 3-year period. And then you have this 6-month period in here of support around the 260 level. That brings you to a general support of 226. One thing to keep in mind is none of this is static. This is a moving average. So as day 201 gets added to the 200-day moving average, then you take out the first day one so that it's always the last 200 days of price. The purple line just gives you the average over the last 200 days. Rather than having to go through and eyeball it and say, I think that people are going to buy between 150 and 200 and they're going to lose hope then. And what about this support level here? These moving averages give you a visual snapshot as to where the support level is going to be. I tend to use that 200-day moving average because it gives me more of a smooth line. The 50-day moving average gives me the idea of how much momentum is in the stock. If the stock has strong momentum, you can see here from 2013 all the way until 2018, 5 years, stock barely goes below that 50-day moving average. That is really strong momentum. Now it starts to break through the 50-day once, twice, it touches it here, it's broken it again there. This is higher volatility. That's where the 200-day is going to give you a better idea of support. And indeed, here in 2018, it crossed just below the 200-day and then recovers. Here again in March 2020, when all the markets seized up around the pandemic, it broke below the 200-day, but snapped back strongly as Fed stimulus was announced. The 200-day gives you a great idea for where support is. That doesn't mean that it can't be broken, but it's broken far less often, as you can see, versus the 50 days. It gives you a little bit of a smoother approach. Let's look at what's happening in the near term. So here's the 200-day. And in the near term, the stock has gone below the 200-day, but as I talked about with this max chart here, it has done this before where it'll cross under the 200-day and snap back. So that might happen again. Let's go back to the 3-month and it's below the 200-day. And the risk here is that your 50-day is getting very close to your 200-day. So if your 50-day crosses your 200-day, that means that the average price of the last 50 days is below the 200-day moving average. So everyone in the last 50 days is back to risk aversion, then people will want to start selling the stock. That's why it's called the death cross, because it will continue to put pressure on the stock. If you imagine, if you just bought something, you're not as married to it as if you've owned it for a while. So on the short-term chart, when the 50-day and the 200-day cross here and the stock is below the 50-day, now you've got all of those near-term buyers that don't have support and are likely to sell. Where's the support level of the people from day 1 to day 150? We've crossed that 50-day moving average. Now the people that purchased over the last 50 days are starting to feel some pain because the stock price is lower than the moving average of the price over the last 50 days. But the 200-day still goes down to this 226. People that are going to start to experience this pain that purchased over the last 50 days are either going to sell or stop buying or sit on the sideline. And so the question to ask here is, where is your next level of support? Where's the average set of people that bought over the last 200 days, and that includes the last 50, but over the last 200 days, the average purchase price is down at this 226, which is much lower than the 317. Those people may still say, oh, you know what, it's 50% above where I bought it. I'm good. I don't really see it as being a particular bargain. When it starts to get between 5–10% of where they purchased it, or maybe it's a 5% loss, then they're going to come back in and purchase. So this is the same thing we're talking about with support levels in terms of where people have bought it. This just gives you a visual way to look at that on a chart. Here is where they're going to support it, which is still down quite a bit. When you have these big gaps between the 50-day and the 200-day, and a stock crosses the 50-day, there's a risk that you can gap down quite a bit before you have a next level of buyers that are willing to add to their positions. If it crosses the 200-day, then you have to look for that next set of buyers, which would be at a much lower level. That's the way I use these moving averages. Let's go back to Google and let's look at Bollinger Bands. Bollinger Bands are right here. I'm going to do it over a 200-day moving average because I find that to be the best. And then I'm going to do 2 standard deviations. So a standard deviation is a way to look at volatility of the stock. It gets cleaned up statistically, standardized. It's how much volatility above or below the regular stock price is there. And typically stocks will trade between 2 standard deviations of their recent stock price unless something really changes fundamentally. It tells you whether stock price movement is just normal noise of general markets, or if there's something that the stock price is signaling to you either about the market or about that stock specifically. So let's take a look at that with Bollinger Bands. This is Google. You can see that it was on its way up, but trading within a range. And so this Bollinger Bands, this is a 200-day moving average right here, this middle band. So it's stayed above the 200-day moving average, but the bands are pretty, and the last couple of years, from March 2020, Google went up far more than it had over a long period of time. And that expanded the general volatility that we have seen. Volatility can be positive or negative, but it expanded it such that now Google is above 2 standard deviations, and it has been since it crossed out of it October 2020. It's been out of that standard deviation for quite a while. This is because we had the pandemic, we were working from home, buying everything on the internet and having things delivered. The role that the internet played in our lives and the amount of time we spent on the internet went up by multiples. That is the explanation as to why we are well above 2 standard deviations, but it does put a risk because typically you trade within this range. And so does that mean that it's going to pull back into this range? Let's take a look at how Facebook looks in this situation. Going to pull in the Bollinger Bands, and I'm going to do the same thing. I'm going to do it on the 200-day. Now we're going to go on the 5-year for Facebook for the Bollinger Bands. And you can see that Facebook also had narrower Bollinger Bands. They're a little bit wider. Facebook is a little more controversial in terms of dealing with regulators, and they have had more volatility over time than Google. So the width of their 2 standard deviations is a little bit wider than Google. And here you can see this is March 2000 when Facebook went up. However, they've still had more issues with the regulators and more controversy, so have not stayed above the Bollinger Bands. They've reverted back towards the mean. And so that keeps the Bollinger Band from being as wide as what we saw on Google. Google's is saying that the volatility has gone up a lot, so the risk is up quite a bit. Or if this continues, then that would be the new trend, and the Bollinger Bands would narrow again, but that has not been confirmed. And so right now you just have a very wide band of what statistically they would be saying would be potential future prices. So I've shown you these 2 huge well-known stocks. Let's look at a tiny stock and see how this relates. This one's a graphene company. It's a really small stock. If you look at the 1 year, we've had a lot of buyers here between this 360 and 264 level. And then we had another set of buyers here from 365 to 369. And then more recently, we were churning between this $5 level and 539. That'll add to a 200-day moving average of $4. And with the recent pullback in tech, you've seen that the stock has pulled back and it's crossed its 50-day. It bounced off its 50-day here. And then notice when it crossed its 50-day, rather aggressively, moving halfway between the 50-day and the 200-day. And that's the next level of support. Let's add the Bollinger Bands to see if I can get a little more visibility here in terms of what's going on with volatility. This is a stock that has more volatility than Facebook or Google because it's so small. If we go to the 5-year, we don't get a lot of data. Let's go back to the 1 year just to get enough data. It's not as relevant when you use the 1 year versus the 5, but that's what we have. And that's what you've got to deal with sometimes with these smaller stocks. You can see that the volatility was never high, but you build a track record of volatility. This is giving you an idea of how much the stock moves in any particular direction. And so here, as a stock, builds a track record of just moving between these two. The width of the bands narrows, then they have some good news and the stock bumps. And also the width of this band bumps up. The expansion goes up a lot because the stock went up a lot, and now it calms down a little bit, but the stock still is more volatile than it was in its past. It's not churning between these two low levels anymore. In fact, in the last month, it has gone from 687 to 505, and that amount of volatility also expanded the bands. These Bollinger Bands are 200-day moving averages. So this down move and this big up move really added to the volatility, which expands the width of these bands. Normally, the stock will trade within these bands because that's how they're defined. So one would expect that it would first bounce off this 200-day moving average. Then if it loses support there, the bottom end of the Bollinger Band can give you another indicator as to where your next support level is. If you're in Yahoo Finance and you say, wow, I just love this, but I don't want to go through here and add all these indicators like Emmy did. Once you have all of these guys lined up here, then you can just go in and put in any stock. Let's just look at one last stock. I've been showing you stocks that have been going up a lot, but what about stocks that have been going down for quite a while? How do you look at where their support level is? These stocks we've been talking about are all at the high end of the Bollinger Band or above the Bollinger Band because they've been going up. So let's talk about a stock that's been going down and what I look for technically to say, when is that stock going to start to work again, just on a technical basis, not on a fundamental basis. When a stock has been going down for a while, it's already experienced the death cross, which is that the 50-day is underneath the 200 days. Here, the 200-day is in orange, the 50-day is in red, and the 50-day is staying underneath the 200-day. When the stock goes down, the 50-day declines faster than the 200-day, and you can see that gap between the 50 and the 200 is widening, declining at an accelerating rate. Not a good thing if you're a holder. The Bollinger Band tells you 2 standard deviations away from your 200-day. That's telling you when people think maybe the value buyers are going to come in. You've already scared out the people that don't have strong hands. You can see here the stock was holding firm above the bottom of the Bollinger Band and flirting with the 50-day. What it would need to do to start to work is to come through the 50-day, come through the 200-day, which it tried to come through the 50-day, and it's just been struggling with the 50-day. But you can see the distance between the 50 and the 200 is narrowing as the stock has had these attempted rallies, versus when it just was going down, there was no narrowing happening at all. In fact, it was widening between the 50 and the 200. But as it started to bounce off of the bottom of the Bollinger Band, and as it started to rally through that 50-day, it's trying to get itself back above the 200-day. As it does that and it moves itself into the higher end of the Bollinger Band, more technical analysts and more buyers in general will start to build their evidence back that the stock has washed out and that there might be some green shoots or some positive news that may be coming. All the sellers are washed out and you have room for new buyers. That's the kind of things that you would look for in a weak stock. I hope that you enjoyed this video. Please subscribe for more tips on breaking into Wall Street from unconventional paths.